How did a young commodities trader from Memphis go from getting fired for falling asleep at his desk to predicting the biggest stock market crash in history, making 200% returns in a single year, and building an $8 billion fortune while giving away over $3 billion to fight poverty? Paul Tudor Jones's story is one of the greatest trading success stories ever told. But this video is also a journey through the art of contrarian thinking, the power of technical analysis, and why the best traders know that defense matters more than offense. And trust me, this story will change how you think about risk forever. Welcome to the incredible rise of Paul Tudor Jones, the man who saw Black Monday coming. The story of Paul Tudor Jones begins in Memphis, Tennessee in 1954. Born into a middle-class family, Paul's father practiced law and published the Daily News. His mother was a homemaker who wanted him to become a preacher. Growing up in Memphis, young Paul showed an early competitive spirit. He was bright, athletic, and driven to succeed at everything he attempted. In 1972, Paul headed to the University of Virginia to study economics. He joined a fraternity and became its president. But Paul also discovered boxing. By the time he graduated in 1976, Paul had become the university's welterweight boxing champion. To help pay tuition, Paul worked for his family's newspaper, writing articles under a pseudonym. This gave him early exposure to business and taught him how to analyze information quickly. When Paul graduated with his economics degree in 1976, he had no clear plan. Wall Street wasn't calling yet. But Paul's cousin ran one of the largest cotton trading companies in the country. He introduced Paul to a commodity broker named Eli Tullis, who agreed to give the young graduate a chance. Paul moved to New York and started his first real job as a clerk on the trading floor. His job was simple: man the phones all day and call cotton price quotes into Eli Tullis's office in New Orleans. It was boring, repetitive work. But Paul was getting paid to learn how commodity markets worked. Then, one Friday morning, disaster struck. Paul had been out all night with friends. When he showed up to work exhausted and hungover, he could barely keep his eyes open. Around noon, things got quiet on the trading floor. And the next thing Paul remembers was a ruler prying his chin off his chest. Eli Tullis had flown up from New Orleans unannounced, and he'd caught Paul sleeping at his desk. Tullis was furious. He fired Paul on the spot. Paul Tudor Jones, future billionaire, was unemployed after just a few months. But Paul went back to Tullis and begged for another chance. He promised it would never happen again. He would work harder than anyone else. And somehow, Tullis agreed to give him a second chance. That moment changed Paul's life. From that day forward, Paul approached trading with an intensity that bordered on obsession. He studied everything: price patterns, supply and demand dynamics, market psychology. Eli Tullis became Paul's first real mentor, teaching him that markets are driven by human emotion, fear, and greed. If you could understand the psychology behind price movements, you could predict where the market was going. Within a few years, Paul had moved from being a clerk to becoming a broker. He was trading for clients, making real money, and building a reputation. But working for someone else wasn't enough. By 1980, at just 26 years old, Paul founded Tudor Investment Corporation with $30,000 in seed capital. Paul's approach was different from most traders. He used technical analysis, studying charts and price patterns to predict future movements. But he also paid attention to macroeconomic trends: interest rates, currency fluctuations, geopolitical events. Paul called himself a global macro trader. From the beginning, Tudor Investment Corporation made money, consistent profits year after year. Paul's reputation grew, and by the mid-1980s, Tudor Investment was managing tens of millions of dollars. But Paul was also developing a reputation for partying. The Wall Street Journal ran a front-page article about his excessive lifestyle. Paul was young, rich, and living like a rock star. But beneath the party lifestyle, Paul was about to make the most important observation of his career. It's the summer of 1987, and something is bothering Paul Tudor Jones. The stock market has been on an incredible run. The Dow Jones Industrial Average had climbed over 40% since the start of the year. Everyone on Wall Street is euphoric. But Paul keeps looking at his charts, and he keeps seeing something that makes him deeply uncomfortable. The market's recent behavior looks eerily similar to the market pattern before the 1929 crash. Paul had a chief strategist named Peter Barish who had been doing the same analysis. He'd created detailed charts comparing the 1987 market to the 1929 market, and the similarities were striking. Both periods saw rapid run-ups driven more by optimism than solid fundamentals. Both showed the same parabolic price curves. Paul and Peter started having intense conversations. Was history about to repeat itself? Most of Wall Street thought the idea was crazy. The economy was strong. Corporate profits were solid. But Paul Tudor Jones wasn't convinced. He could see that the current market was being driven by pure greed. Everyone thought stocks only went up. It was a classic bubble. So Paul started positioning Tudor Investment for a crash. He began buying massive amounts of put options on stock indexes. He also started shorting stocks directly, betting that prices would decline. Most importantly, Paul didn't keep this prediction to himself. PBS was filming a documentary about Paul called Trader. In the documentary, Paul openly discussed his belief that a major market crash was coming. He showed the 1929 comparison charts. He put his reputation on the line. As summer turned to fall, the stock market continued climbing. By early October 1987, Paul's short positions were losing money. Some of his clients started questioning his judgment, but Paul held firm. He increased his short positions. He bought more put options. Monday, October 19, 1987 started like most Mondays on Wall Street. But within the first hour of trading, something was clearly wrong. Stock prices started falling fast. By midday, the market was in complete freefall. The Dow Jones Industrial Average was down over 500 points, a decline of 22.6% in a single day. It was the largest one-day percentage decline in U.S. stock market history. Trading floors across Wall Street descended into chaos. Some investment firms were facing bankruptcy. It was absolute pandemonium. But at Tudor Investment Corporation, Paul Tudor Jones was calm. Every put option he'd bought was now worth multiples of what he paid. Every short position was generating massive profits. As the market fell 22%, Paul's fund was exploding upward. By the end of that October, Tudor Investment Corporation had made a 62% return. For the full year of 1987, the fund returned an incredible 200% after fees. Paul had tripled his investors' money in a single year by making one of the greatest market calls in history. Paul Tudor Jones became an overnight legend. He was 33 years old and had just achieved what most traders only dream of. A perfect trade that made him rich and famous simultaneously. But Paul wasn't purely happy about his success. In interviews later, he said the crash of 1987 was probably the worst trading call of his entire life. Not because he lost money, but because he'd feared it would trigger an economic depression. He'd made a fortune, but he worried about what it meant for ordinary people. That concern was about to change Paul's life in a profound way. Just months after Black Monday in 1988, Paul was watching a 60 Minutes episode about a businessman who had offered to pay for college tuition for an entire class of students in Harlem. Paul was moved by the story. His mother had always wanted him to be a preacher, to help people. And while Paul had built a financial empire, he hadn't really given back. Paul immediately called the businessman and asked how he could help. He adopted a school in Brooklyn and started an I Have a Dream program, promising to pay for college for students who stayed in school and graduated. But Paul quickly learned that money alone wasn't enough. Many of the students ended up dropping out anyway. Paul felt like he'd failed them. Instead of giving up, he decided to think bigger. He invited some friends over. Peter Barish from Tudor Investment, Glenn Dubin, who would become a legendary hedge fund manager, a few other traders. Over Chinese takeout, they talked about how they could really make a difference fighting poverty in New York City. That night, they came up with an idea. What if they applied Wall Street principles to charity? What if they ran a foundation the same way they ran hedge funds? Rigorous analysis, clear metrics, defunding programs that didn't work and doubling down on programs that did. They decided to call it the Robin Hood Foundation. The key innovation of Robin Hood was that the board of directors, all wealthy individuals from the hedge fund world, would cover all administrative costs. This meant 100% of donations would go directly to fighting poverty. No overhead, no bureaucracy, just direct impact. Paul applied the same intensity to philanthropy that he'd applied to trading. Robin Hood would measure everything. And if a program wasn't delivering results, Robin Hood would cut funding without mercy. This approach, later called venture philanthropy, was revolutionary. By 2024, Robin Hood had invested over $3 billion in poverty-fighting programs across New York City. Paul had achieved something remarkable. He'd become rich by predicting market crashes. And then he'd use that wealth to build one of the most effective charitable organizations in America. Throughout the 1990s and 2000s, Tudor Investment Corporation continued generating strong returns. The firm managed billions of dollars and employed sophisticated trading strategies across global markets. But Paul's approach to trading had evolved. After the intensity of the 1987 crash, he became more conservative. He focused more on capital preservation. His famous mantra became, "Playing great defense matters more than aggressive offense." This defensive approach meant Tudor's returns were solid, but not spectacular compared to the early years. But Paul was fine with that. He'd rather make consistent profits than swing for home runs and risk blowing up. Paul also became more reclusive over the years. The documentary Trader became a cult classic. But in the 1990s, Paul requested that it be removed from circulation. Various theories exist about why. Some think he wanted to keep his trading strategies secret. Through it all, Paul continued trading and continued his philanthropic work. He expanded beyond Robin Hood, founding the Everglades Foundation to focus on environmental conservation. He became a major donor to the University of Virginia, giving $44 million to build a basketball arena. In 2019, Paul joined the Giving Pledge, promising to give away most of his wealth. Tudor Investment Corporation adapted to changing markets. Paul began incorporating quantitative trading systems and algorithms. The firm even started charging lower fees, reducing to the industry standard 2%. Paul also became an early adopter of Bitcoin and cryptocurrencies, calling Bitcoin an excellent inflation hedge. In 2021, he revealed he'd put about 2% of his portfolio into Bitcoin when it was trading around $13,000. It would eventually exceed $100,000, validating his contrarian bet once again. Today, at 70 years old, Paul Tudor Jones remains active in trading and philanthropy. Tudor Investment Corporation manages approximately $12 billion in assets. Paul's personal net worth is estimated at over $8 billion, making him one of the wealthiest people in finance. So what can we learn from the incredible story of Paul Tudor Jones? First, second chances matter. Paul was fired from his first job for falling asleep at his desk. But he begged for another chance, got it, and never forgot that lesson. He worked harder than anyone else from that moment forward. Second, contrarian thinking is powerful but requires conviction. When Paul predicted the 1987 crash, almost everyone thought he was wrong. He lost money for months as the market kept climbing. but he had done the analysis. He believed in his thesis, and he had the courage to bet big when the moment came. Third, technical analysis and pattern recognition matter. Paul's prediction of Black Monday wasn't based on complex economic models. It was based on recognizing that the 1987 market looked eerily similar to the 1929 market. Simple chart patterns that anyone could have seen. But Paul was one of the few who took it seriously. Fourth, defense matters more than offense. After his 1987 success, Paul could have kept swinging for the fences. Instead, he became more conservative, focused on capital preservation, and accepted smaller but more consistent returns. This approach let him compound wealth safely over decades. Fifth, success isn't just about making money. Paul could have retired after Black Monday and lived in luxury forever. Instead, he built Tudor Investment into a multi-billion-dollar firm. And more importantly, he channeled his wealth into fighting poverty through Robin Hood. Sixth, measure what matters. Whether in trading or philanthropy, Paul obsesses over metrics. What works? What doesn't? Robin Hood defunds 10% of programs every year that don't deliver results. That ruthless accountability is rare in charity, but it's why Robin Hood has been so effective. Finally, Paul's story shows that the best traders evolve. He started as a cotton trader, became a macro trader predicting market crashes, adopted quantitative systems, embraced cryptocurrencies. He never stopped learning and adapting to new market conditions. Looking back at Paul Tudor Jones's career, it's remarkable how many legendary moments it contains. The firing and second chance, the Black Monday prediction, the founding of Robin Hood, the 200% returns, the decades of consistent success, the billions given to charity. For aspiring traders, Paul Tudor Jones offers a blueprint. Study the markets obsessively. Think independently. Have the courage to make contrarian bets when your analysis supports them. Focus on not losing money first, making money second. And remember that wealth without purpose is empty. For philanthropists, Paul offers a different blueprint. Apply business principles to charity. Measure results ruthlessly. Fund what works, defund what doesn't. And commit fully, not just with money, but with time and expertise. Paul Tudor Jones proved that you can predict market crashes, make billions, and still be a force for good in the world. His mother wanted him to be a preacher. In a way, through Robin Hood, he became one, just with a very different pulpit. And that's the incredible story of Paul Tudor Jones, the man who got fired for falling asleep at his desk, learned from his mistakes, predicted the biggest stock market crash in history, made 200% returns, built an $8 billion fortune, and gave away over $3 billion to fight poverty. A story of persistence, courage, contrarian thinking, and the power of using success to create meaning beyond yourself.